Moral from the week just gone is that you shouldn't trust central banks, and that's possibly the right moral to go into the next week as well. Obviously, the big development this week, true shock, was the decision by the Swiss National Bank to remove the floor of 120 to the euro that it had put under the Swiss franc. It allowed the franc to appreciate, the euro to weaken, and the result was perhaps the single most dramatic day of foreign exchange trading between developed market currencies ever. Very dramatic falls apparently seems to have led to the bankruptcies of some large foreign exchange traders. For the future, perhaps the single most important development, to paraphrase Martin Luther King, as this is his birthday coming up, is that the euro is weak at last, weak at last. Thank God Almighty, it's weak at last. This is the euro's trade-weighted index, and you can see that apart from a few weeks at the very worst of the crisis, it is now as weak as it has been in more than a decade. There was a great mystery as to how the euro had managed to stay so strong during a long period when its very existence had been in doubt. It now looks as though the Swiss cap was indeed a lot to do with this. Now, there are other important driving factors behind what the Swiss have just done. If we take a look at this chart, you can see that Swiss government 10-year bonds now have a negative yield, a quite extraordinary development, meaning that if you want the Swiss government to look after your money for the next 10 years, you will have to pay them for the privilege. Now, while that is obviously the most dramatic example, you can see that both German Bunds and Japanese JGBs are getting there, and the fact that such low yields are on offer elsewhere in the world means that even US Treasuries, part of a much stronger economy. We found out today that consumer sentiment is back to where it was in 2005. Even in the US, this puts pressure, downward pressure on bond yields, because even those yields begin to look attractive in this environment. It's a quite remarkable picture of falling yields, which implies great negativity about the economy. Now, apart from the SNB, the week saw falls in stock markets, which were arrested somewhat at the end of the week. That was largely because we saw a bounce in commodity prices. Both oil and copper, after sharp sell-offs, staged quite a recovery the last few days of the week. It's far too soon to call a bottom, but it was certainly a bounce that made people in the equity market feel a lot better. Coming up next week, we will have lots of earnings from the US, but plainly by far the most important event will be the meeting of the ECB on Thursday, where the belief now appears to be universal that they will announce their own bond buying program, sovereign QE. Now, you should always be careful, as we learned from the SNB in the week just gone. You should always be careful when people are that confident about what a central bank is going to do. I even saw one research note which described sovereign QE as a done deal. Perhaps the consensus is that they'll buy back something like 600 billion euros of bonds. Bear in mind that there are very difficult politics within the ECB. Many really don't want to do this. Also, that the very fall in the euro arguably has done some of their job for them. It tends to ease conditions in the eurozone that they have a weaker currency. I would therefore caution that it would be very unwise to take what the ECB is going to do for granted.